Welcome back to the deep dive. Okay, so today we're tackling a topic that, well, it touches every single one of us, often without us even realizing just how powerful it is: inflation. It's often called a silent wealth killer, and that's pretty accurate. It's this powerful economic force that quietly, just relentlessly erodes the value of our hard earned money over time. Our mission in this deep dive isn't just to understand inflation, but to really equip you with some robust, actionable strategies. We want you to be able to protect and, yes, grow your wealth, feeling confident no matter what the economy throws at us.
Yeah, it's an incredibly relevant topic right now. And what's fascinating really is how universal this challenge is. I mean, whether you're managing your finances in the USA or maybe Australia or anywhere else, the core principles for protecting your purchasing power, they stay remarkably consistent. The guide we're looking at today offers a genuinely clear roadmap. It sort of cuts through the noise, giving you these direct, practical insights that are just essential in today's economic landscape.
Absolutely. Think of this deep dive as, well, your shortcut to getting up to speed on this really critical subject. We're taking that guide, which focuses on real world stuff, groceries, housing costs, and we're boiling it down to the most important bits. Our goal is simple: for you to walk away with not just knowledge, but actual strategies you can maybe start thinking about or even implementing today. So let's kick off by really getting a handle on this invisible threat. What does inflation actually mean for your wallet? Basically, prices go up across the board. Your money buys less. Simple as that. To make it real, think about this. A gallon of milk in the USA, back in 1990, maybe $2 today. It's closer to $4.50. Or for our listeners down under, imagine a grocery shop that cost you, say, $50 back in 2000. That same basket of goods now, it's going to set you back over $110. That is inflation in action. It's not theory, it's your money buying less day to day.
And connecting that to the bigger picture, economists don't just, feel this, they measure it meticulously, primarily using the Consumer Price Index, the CPI. The CPI basically tracks the average price changes for a whole basket of consumer goods and services. Think food, housing, transport, healthcare, all that stuff. And, well, those numbers can be quite startling sometimes. In 2022, we saw U.S. inflation jump to 9.1%. That was the highest in 40 years. Australia saw similar pressures, hitting 7.8%, a 30-year high. These aren't just stats. They really show how fast your money's value can shrink.
That context is so important. But what's actually driving these big shifts? It's not just one thing, is it?
No, not at all. Precisely. The guide points to three main culprits, really. First, you've got demand pull inflation. That's basically when there's too much money chasing too few goods. It's like an option.
Yeah.
Everyone wants something limited, so prices get pulled up. Then there's cost push inflation. This happens when it just costs more to produce things. Maybe raw materials get expensive or wages go up or supply chains get messed up. Businesses then, well, they often pass those higher costs on to us, the consumers. And lastly, there's monetary inflation. This is often tied to an increase in the money supply itself. More money floating around can dilute its value, meaning you need more of it to buy the same things. And often, these things don't happen in isolation. They kind of interact and can even amplify each other.
Right. And a really crucial point, one that often catches people off guard, is the impact on what people think of as safe money. Their savings. Imagine you've got $10,000 saved up. It's sitting in an account earning maybe 0.5% interest. Okay. But what if inflation is roaring along at 6%? The guide lays it out pretty starkly. In just 10 years, the real purchasing power of that 10 grand gets effectively cut in half. It drops to being worth around $5,500 in today's money. That's a real aha moment, isn't it? It really shows how doing nothing, just letting your money sit there, is actually like losing money.
It absolutely is a guaranteed loss in real terms. And this same dynamic plays out dramatically in assets people might think are stable or, always go up, like housing. Look at the median house price in the U.S. It went from about $120,000 in 1990 to, wait for it, $436,000 in 2024. Or you're in Sydney, Australia. The median house price jumped from $287,000 in 2000 to over $1.1 million in 2024. These aren't just small fluctuations. They're massive signals that simply holding on to cash or underestimating inflation's bite over the long haul just isn't a winning strategy for keeping or growing your wealth. So this brings us to our first actionable step for you, the listener. Really actively compare the interest rate you're getting on your savings with the current inflation rate, and maybe make a conscious decision to start owning assets that tend to appreciate over time rather than just letting cash sit idle.
Yeah, that leads perfectly into the next critical piece, this mindset shift. Moving from just being a saver to becoming, well, a strategic investor. For years, we heard cash is king, right? The ultimate safe place. That was the standard advice. But in today's world, with inflation being what it is, that old advice isn't just outdated, it can actually cost you. The guide really spells out the math of loss. Say you have $50,000 in savings, earning a tiny 1% interest, but inflation is running at 4% over 10 years. The real value, the actual purchasing power of that $50,000 shrinks down to about $36,000. That's a big chunk gone, just eroded away.
It really hammers home that concept of opportunity cost, and it raises a key question. When does cash make sense? The guide makes a really important distinction here. You absolutely need an emergency fund. That's non-negotiable. Typically, 3 to 6 months worth of essential living expenses. That's your safety net, right?
Yeah.
For job loss, medical bills, unexpected stuff. But beyond that crucial buffer, the advice is pretty clear. Don't hold loads of excess cash. Money just sitting in a low-interest account is actively losing value day by day. Your capital needs to be put to work, earning returns that hopefully beat inflation, or at least keep pace with it.
So the core idea here is a fundamental change in thinking. The guide really pushes for shedding that old mindset of save cash, avoid all debt, and adopting something more dynamic, more proactive. It's like grow assets, maybe use good debt strategically, and definitely start investing, even if you're starting small, just consistently. It's not about being reckless, it's about being smart with your money. And the examples the guide uses are really compelling. Think about putting $50,000 into a broad market index like the S&P 500 back in 2010. By 2024, that could have grown to well over $170,000. That shows the power of market growth over time. Or for our Australian listeners, putting $30,000 into an ASX 200 ETF could have roughly doubled your money in about a decade. These aren't just numbers. They show that investing strategically, even with modest amounts, can make a huge difference, especially when inflation's eating away at cash. Okay, so let's get practical. Diving deeper. What specific assets actually help you stay ahead of inflation? The guide lays out a kind of inflation-beating arsenal, doesn't it?
It certainly does. It gives some clear categories to think about. First up, often the foundation for many people is stocks. The guide really emphasizes diversified exchange-traded funds, or ETFs. They give you broad market exposure, which helps spread out risk compared to picking individual stocks. So for U.S. listeners, think S&P 500 ETFs like VOO or SPY. In Australia, you've got ASX 200 ETFs like VAS or A200. The idea here is that good companies, especially ones that can raise their prices, can often pass along rising costs to customers, protecting their profits. Dividend stocks are also mentioned. Those regular payouts can provide a rising income stream, which helps offset inflation too.
So it's not just about buying any old stock, but being smart about diversification and looking for companies with resilience.
Exactly. Strategy matters. Next category, real estate. This covers a few things. Direct ownership of rental properties, for instance. You get a tangible asset plus rental income that tends to increase over time with inflation. Now, if being a landlord isn't your thing, there are real estate investment trust ETFs, REIT ETFs. Think VNQ in the US or DJRE in Australia. These let you invest in property markets without the hassle of direct ownership. The guide also touches on rent vesting. That's where you might rent where you prefer to live, maybe for lifestyle reasons, but buy an investment property somewhere more affordable, letting your capital grow. Why does property work? Well, land is limited, people always need places to live, so both property values and rents tend to climb with inflation historically. We already mentioned those huge price jumps. U.S. homes up 260% since 1990, Sydney nearly quadrupling since 2000. That's strong evidence for real estate as a long-term inflation hedge.
Okay, stocks and property make sense. What else is in the toolkit?
Well, we also look at commodities and gold. Gold especially has this long history as a sort of safe haven, a store of value when economies get shaky or inflation spikes. ETFs like GLD make it easy to get exposure to gold. Some mining stocks can offer exposure too. Commodities in general, the raw materials for everything, their prices naturally tend to rise with inflation. But it's worth saying, these can be more volatile than, say, a broad stock ETF or real estate, so they usually play a smaller, more strategic part in a well-rounded portfolio.
What about bonds? People often think of them as safe, but how do they hold up when inflation's high?
Yeah, that's a really important point. With bonds, you need to be specific. Standard bonds, the ones with fixed interest payments. They actually get hurt by inflation because those future payments buy less and less. However, the guide highlights inflation-protected bonds, like TIPS in the U.S. or inflation-linked bonds in Australia. These are pretty clever. Their principal value, and therefore the interest they pay, actually adjusts upwards with inflation, usually linked to the CPI. So that direct link gives you a shield against rising prices. It helps make sure your bond investment doesn't lose its real purchasing power.
That's a critical difference. Okay, this might sound like a lot for someone just starting out. Does the guide offer simpler advice for beginners?
Well, absolutely. It keeps it very clear and empowering for beginners. The core message is, start early, be consistent through dollar cost averaging, and keep it simple, often with index funds. Dollar cost averaging just means investing a set amount regularly, say every month, no matter if the market is up or down. It smooths out your purchase price over time and takes the emotion out of trying to time the market. And the guide really drives home the magic of compounding. It uses an example. Investing just $500 a month, if you get an average 8% annual return over 30 years, could potentially grow to around $745,000. It just shows the power of starting early and staying consistent. Your money really starts working for you. And if we connect this back to the bigger picture, your income itself is one of your most powerful assets against inflation. The guide really stresses how important it is to actively grow it. You can't just sit back and hope your standard pay rise covers things.
Right. It's about actively managing your earning power, making it more resilient.
Precisely. It's not passive. The guide suggests a few key things. 1, actively ask for raises regularly, and aim for raises that at least match or ideally beat inflation. Know your value, make your case. 2, upskilling and reskilling. Keep learning, stay competitive, invest in yourself basically. Make your skills valuable in the job market. And 3, think about side hustles. Diversify your income, maybe freelance work, maybe starting a small online thing. Don't rely solely on one paycheck.
So what does this mean in real terms? The guide has some great examples, like someone learning digital marketing skills and boosting their income by $30,000 pretty quickly. Or for our Australian listeners, it mentions trades apprenticeships potentially increasing earnings by 20–30% within just a few years after finishing. The message is clear. Investing in your ability to earn more is a direct, powerful way to fight inflation.
And this brings up another important question, one that's easy to miss. Taxes. How does inflation sneakily affect our taxes? It causes something called bracket creep. Inflation pushes your nominal income, the dollar amount, higher, potentially into higher tax brackets, even if your actual purchasing power hasn't gone up at all. So you end up paying a bigger slice of your income in tax, even though you're not really any better off. The guide outlines ways to fight back. Maximize contributions to tax-advantaged accounts, your 401ks and IRAs in the U.S., superannuation in Australia. These let your investments grow shielded from taxes year to year, which really helps combat that bracket creep.
And you mentioned a couple of other strategies, negative gearing in Australia and capital loss harvesting. Can you break those down quickly?
Sure. So negative gearing, mainly for Australia, applies mostly to investment properties. It's when your deductible expenses like mortgage interest, council rates, repairs are actually more than the rent you collect. This creates a loss on paper, which you can then use to reduce your taxable income from other sources, like your job. The idea is you accept a small running loss now, hoping the property value grows significantly over time. And capital loss harvesting, that's something you can do in many places, U.S. and Australia included. If you have investments that have lost value, you can sell them to realize that loss. You can then use that loss to offset any capital gains you made on other investments that went up. This reduces your overall capital gains tax. In some cases, you might even be able to deduct a small amount against your regular income. It's basically smart portfolio management to minimize your tax bill, especially useful when markets are choppy.
That's really helpful clarity. Now, looking even further down the road, retirement. Inflation is a massive threat there, often underestimated. The guide paints a stark picture. If inflation runs at a steady 5%, that $50,000 you thought was a decent yearly income today, well, in 20 years, you'd need over $132,000 just to buy the same amount of stuff. That's quite a wake-up call for retirement planning.
It really is. It means your planning has to account for it. But the guide offers solutions. You need to keep a portion of your retirement savings in growth assets like stocks and maybe real estate even when you're retired. This helps your nest egg keep growing and hopefully outpace inflation. Also, look into inflation-indexed pensions or annuities if available. These are designed so their payouts adjust upwards with the cost of living. Diversifying income streams in retirement is also key. Don't rely on just one source. And maybe controversially for some, planning for a potentially slightly delayed retirement could give your assets more time to grow and provide a bigger buffer against those rising prices later on.
You know, maybe one of the most interesting insights here is that high inflation often goes hand in hand with general economic uncertainty, market swings. Which, let's be honest, can make anyone feel nervous, right? Even if you feel informed. It's exactly during these turbulent times that having a clear, disciplined strategy is not just helpful, it's absolutely crucial.
Absolutely critical. And the guide gives a really practical checklist for building resilience when things feel stormy. Number 1, maintain that emergency fund. We talked about it before, but it's doubly important now. It stops you from being forced to sell investments when prices are low just to cover unexpected bills. 2, diversify globally. Don't put all your eggs in one country's basket. Spreading investments across different markets can cushion the blow if one region hits a rough patch. 3, Keep holding some inflation-resistant assets. Those things like gold, maybe TIPS or inflation-linked bonds we discussed. They often behave differently from stocks and can act as a buffer. 4. Rebalance your portfolio regularly, maybe once or twice a year. Sell some winners that have grown too large, buy more of what's lagged. This keeps your overall risk level where you want it and forces you to buy low and sell high, systematically. And number 5, probably the hardest but most important, avoid panic selling. Market downturns feel scary, but reacting emotionally and selling everything is usually the worst thing you can do. History shows markets recover.
Staying educated, having a plan, helps you stay calm and stick to your long-term strategy when others are freaking out.
Okay, so pulling all these threads together, what does this really mean for you listening right now? Inflation, yeah, it's a powerful force. It's persistent. But what this deep dive shows, I think, is something really empowering. With the right knowledge, adopting a proactive, strategic mindset, and taking consistent action, you really can protect your money. You can grow your wealth, not just despite inflation, but maybe even by understanding how it works and navigating those currents smartly. It's not about fighting the tide. It's about learning to sail better, right?
Exactly. And maybe that leads to a final important question for you, our listener, to think about this week. Given everything we've talked about, what's just one tangible step you could take, maybe right now or tomorrow, to look at your own finances through this inflation-proof lens? Maybe it really is just pulling up your savings account statement online and seeing what interest rate you're actually getting, then comparing it to the latest inflation numbers. Or maybe it's spending 15 minutes researching a simple, diversified ETF that might fit your goals. The point isn't to achieve perfection overnight. It's about making consistent, informed progress, taking control.
We really hope this deep dive has given you plenty to chew on and maybe some clear pathways forward. Thanks so much for joining us. Until next time, keep learning, keep growing.